Hi guys. So one of the questions that I get asked a lot is where is the best place to invest in an inflationary environment? Now we've seen this a lot more recently with the Russia-Ukraine crisis, but also the ongoing from the coronavirus when central banks have put a lot of money into the system to stimulate the economy. One of the effects is rising interest rates that again pushes inflation. Now also we've had oil prices rising again as subsequent of the Russia-Ukraine conflict, and obviously OPEC don't want too much to aren't obverse to having rising oil prices, so they're not going to look to keep it that way. So in terms of investment or your portfolio, what is a good option? Now we've touched this quite a few times in previous videos and blogs. I think I did it in early part of 2020 and 2021. So speaking now in March 2022, still want to reiterate and go over it. And that is look for companies with good moats, look for companies with good profit margin, and look for companies within the defensive sectors. So for example, companies like Johnson & Johnson, Unilever, Reckitt and Kaiser, they're still going to be producing goods regardless of if there's a conflict, regardless if there's inflation or not. Those goods are essential. One of the funds that you may want to look for is in the use, it's not specific financial advice, it's the Morgan Stanley's Global Brands fund. It uses specific companies that are used every day with a high moat around them. Also, to a lesser extent, Terry Smith's Fundsmith is a good one to go into in that, or more generally, specific income funds. They're more defensive. On the kind of opposite end of the spectrum, Schroders Recovery Fund is a popular one where it invests in more UK kind of defensive companies, the likes of BT, utility companies, and that have a strong moat and people that are going to use regardless. So if there is an inflation, look to maybe rebalance your portfolio into more defensive sectors if you still have gains. If you anything like me and you have quite a significant loss in your portfolio from you're looking kind of growth stocks, or just hold on and keep your portfolio as it is. Many of the people that are invested in growth portfolios or growth funds, stocks, etc., are invested for the long term. So don't worry too much about the dip in your portfolio. Keep to your strategy, keep to your plan, your asset allocation, and just keep it on. And like I said, use dollar cost averaging to make the most out of your investments. In terms of what I think is going to happen over the next few years, I think we are going to go into a period of high inflation as what we've seen. So if you are looking more short, medium term and want to take advantage out of that kind of macroeconomic effect, look for companies, like we said, with high moats, with high profitability, and in defensive sectors. And funds for that, or popular funds, shall we say, are the Morgan Stanley ones. Bailey Gifford Income Funds, another good one. The TR on that's around 0.53, so for an active fund it is pretty reasonable. For the cheaper side of the funds, you've got the Vanguard Dividends. Off the top of my head, I think it's 0.22% or 0.15%, so that's a cheaper option if you're looking for a passive one. Or a popular one as well is bit more growth orientated than income, but is Terry Smith's Fundsmith. That he is notorious for selecting funds with a high moat and good profitability. There you go, guys. I hope you find that useful. Thanks a lot, and if you have any questions, feel free to go to info@investmentforexperts.com.